So it's still January 22nd, and we are returning to the topic of income taxes. If folks can remember back, gosh, I think it was just last week. When we heard from Kirby about personal and corporate income taxes, and now we're going to do sort of that parallel deep dive with Pat from JFO. Thanks for joining us. And again, the framing for this is we do need to do our federal link up. We heard from the state economist today that, federal taxes are going to be, we have no idea what will happen with federal taxes this year. And so it's a good year to be particularly attentive.
Hello, everyone. I am Pat Titterton. I'm with the Joint Fiscal Office. It's good to finally be in here.
Oh my God, is this your first time?
This is.
I'm so sorry.
I'm in the room. So if you all don't want to tell me everyone's names again, that's fine, because I think I know them all at this point.
We're all very happy to meet you and be here with you.
Well, there's a lot of familiar faces, both from maybe a couple of years ago and just last year, but welcome to all the true new ones. So I guess just to tell the newer people, I'm with the Joint Fiscal Office, obviously. My main portfolio, which comes across your desk, is usually in the personal income and corporate income space. I will on occasion come in on things ranging from like paid leave or sports betting or some of those other sort of random things that kind of pop up. So I'm 1/3, or I guess at this point, 1/4 of the revenue team next door. So yeah, if there's anything else you want to know about.
I don't know if you want to open that door, Pat.
Within reason. So yeah, as the chair mentioned, minimize all these screens. I'm going to do kind of to build off what Kirby walked you all through, I think like last Wednesday or Tuesday or something. I took a little bit of umbrage when he mentioned that he does not like talking about corporate income taxes. But I hope that you all will be very excited to hear about it. I have been told before in performance reviews that my portfolio is a bit Byzantine. So hopefully you all don't feel that way as well.
It's outrageous.
We like it.
Justin.
So yeah, I thought I'd start just kind of the same order that Kirby went through. And that's just talking about personal income taxes. And kind of what I want to focus on is, again, where we start, how that flows through, a lot of the adjustments we make, and then some of the numbers that are associated with it. So like Kirby mentioned, the starting point for all of this is the 1040 IRS form, which is how we get to AGI. It's a lot of the things you think of as income, your wages, some business income, IRA distributions, Social Security, that kind of thing. So all of those things sort of build up to our starting point, which is the federal adjusted gross income. That's just putting all those pieces together, and that's our starting point. So we start there, but there are a couple of things that the feds allow to be removed from that definition, but we add them back in. One being bonus depreciation, another being non-Vermont state and local bonds, so the interest on that income. We want Vermonters to be buying our municipal bonds, for example, to support projects that they undertake. But then we do make a bunch of adjustments right off the top. So a couple that you're probably very familiar with, one being the standard deduction, and the other being personal exemptions. Those are two things that we use right off the bat to both reduce income and also adjust the starting point for your taxable income to adjust for basically family composition. That's where the personal exemptions come in, because the more people you have in your family, the more expenses you're going to have. And it's sort of accounting for the fact that, supporting two people is different than supporting 4 people, for example. There are a lot of other exemptions and deductions that kind of come out at this stage in the process. I'll get into a little bit what those mean a little further on, but there's a couple of just examples here. Capital gains exclusion, There are exemptions for Social Security income. And so that's sort of our first step.
Representative Odie.
For charitable contributions. What's that fit into? We made a change a few years ago. I remember there was about, and can you tell me what we did and how that fits into the link up?
So I have a couple of slides later on that go through some recent personal income tax changes. So if you're okay with waiting until then, I have a bullet point on just what you did.
Right.
So yeah, after all these adjustments, we get to Vermont taxable income. So that's our basis, and that's at the point where we get into talking about brackets, because this is what is going to be applied to the brackets, which vary by filing status. Again, they're marginal tax rates. So if we look at the single bracket there, anything up to 47,900, that's taxed at that 3.35 rate. The next bracket, only the dollars within that next bracket are taxed at that 6.6% rate. So that's kind of how the tiered effect or progressivity of the marginal tax brackets work. So after we flow through those brackets, you get to the initial Vermont income tax liability. And so this is before we get to credits. And I have another slide a little later on, just again, sort of defining what credits are versus exemptions and deductions, because there is sort of a direct effect on one side and an indirect effect on the other side. But, so here are the brackets for all four filing types. Again, lowest rate starts at 3.35, highest rate goes up to 8.85 or 8.75. And what I want to do next is sort of look at how that stacks up both to our neighbors and to sort of nationally. So here on the left, I have the married filing jointly bracket. On the right, I just have a table comparing what the top marginal rate is in some of our surrounding states. You'll see here, we're kind of in the middle of the pack in terms of what the top marginal rate is, but you can see it on the far right column of that table, that where that starts is different in each state. I mean, in New York, I mean, this is essentially like a high rolling investment banker or New York Knicks athlete sort of tax rate. Those really high earning people. But in Vermont, you know, we're starting just a hair under 300,000. So it doesn't really tell the whole story to just look at top marginal rates. And just like it doesn't tell the full story just to look at the lowest marginal rate. And the reason for that is just this chart right here. So Vermont is in green here. And you actually can see at lower income levels, we're actually taxing people at a lower marginal rate. And one thing I'll point out is this doesn't take into account any of the credits or exemptions that we also have in the state. This is just if we're looking at how that rate adjusts by income without any of the other adjustments.
So that doesn't take into account like dependents or child tax credits or anything like that.
Doesn't take
Okay.
into account any of that stuff. It's just what does the rate schedule look like? And you can see even when we're just talking about the rate schedule, on the lower end of the income spectrum, we're lower than a lot of our surrounding states. We are higher at the highest marginal tax rate, but you know, overall, you know, I think you had Chris come in here, and I think Ted had talked about this a little bit about sort of one of the principles being like ability to pay and progressivity of the tax system. So what this sort of highlights here is a progressive approach, meaning that higher incomes are getting hit at higher rates, lower incomes getting hit at lower rates. This is mostly just for reference. This is sort of nationwide, what the top marginal rates are in each state. Obviously, anything you see in gray, they don't have that. So, yeah, if you're
Like California, there are some municipalities that have their own tax rate, non-income tax rate, like San Francisco. Is that included? Is it the highest marginal tax rate for anyone in California? Any municipality?
So this is a tax foundation chart. I don't believe they're taking that into account, so I also don't think it includes like New York City's has similar type deal. But yeah, I don't think this is taking that into account, so obviously it's not something we have here, but
And this again also isn't really like effective in terms of
right.
tax credits. Okay.
And one thing I want to show you in a little bit is a chart that you maybe already saw, but it is effective tax rate all along the income.
Like me.
Yeah. So yeah, kind of going back to where we were. So after we got through AGI, making those adjustments, getting to our sort of taxable income amount, and then flowing them through the brackets, what we get spit out on the other end is the initial Vermont tax liability. And so this is before credits, which I mentioned earlier. So from this point, we're subtracting non-refundable credits first from your tax liability. Then we're subtracting refundable credits. And then from there is a sort of apportionment, like I think you've probably heard of 6 months in a day for people who want to maintain residency status in one place or another.
You can finish your sentence if you want.
Okay, it's just for people who don't earn all of their income in the state. You know, we give them allowance where they're able to sort of reduce the amount that is actually allocatable to the state.
Thank you. Still learning. Can you just quickly define non-refundable versus refundable credits?
Absolutely.
I mean,
So well
you're still
done.
good. No, I'm just.
Yeah, so we saw on the very first part of the flow chart, we started with AGI, and those initial adjustments that are made at that point are what we refer to as exemptions and deductions. So those are lowering your taxable income. So this is pre going through the brackets, right? So that's kind of what I referenced earlier as the like indirect way that the state will lower income tax liability. The other form is a dollar for dollar match. We set what the amount is that you can reduce your liability by. If you are eligible for it, then that's just a straight subtraction from your tax liability. So there's two types. First being refundable, which is basically means that if your tax bill is less than the amount of the credit, then you can get the difference back in the form of a refund. And so the example I have here is super simple. If your tax liability is $100, but you're eligible for a credit that's worth $200 and it's refundable, then your tax liability goes to zero, and you actually get a $100 refund, which is the difference, back into your account. So non-refundable is super similar, but you can miss in that second piece. Same example, $100 liability, eligible for a $200 non-refundable credit. Your liability gets zeroed out, but you don't get the refund. So that's just the difference there. This is not an exhaustive list, but these are a bunch of examples of exemptions and deductions we have on the books, along with certain credits. We have a quick plug. We have a lot of great detail and reports on a lot of these different exemptions and credits on the JPO website.
Is there a report about the code improvement tax code?
Sorry, could you say?
I'm just kidding.
There might be. I just couldn't hear.
It's a code improvement tax credit, but
There is
there is a report.
report on that. Absolutely.
Oh my
It's
God,
part of the Downtown and Village Tax Credit Program.
great.
Yeah.
Okay.
So yeah, like I said, there's a lot of reports on this. These are all included in the tax expenditure report, which I think you've heard a little bit about. And just to highlight that point, this chart here is from results from the tax expenditure report, which I think was just maybe published yesterday. And so you can see in the personal income tax world, the biggest sort of tax expenditure we have has historically always been the earned income tax credit. Kind of a new player on the scene as of a year or two ago is this child tax credit. I'm remembering back to the results from last year. I think this is maybe about on par with what we saw the expenditure last year, maybe slightly higher. And I guess as a quick aside, has the term tax expenditure been defined for this group?
Yes, but you're welcome to.
Okay, well, it's really just because it's foregone revenue and it's going into Vermonters' pockets, it's almost like you're spending the money. So we call it a tax expenditure because it's basically, by not collecting it, it's like the state is spending it. To support, either certain activities or to give credence to the fact that some people may need financial support for certain things in their life. Okay. So this is going to be kind of a review of.
Representative Bodie?
A couple of slides back,
Sure.
I heard something, might not have been what you said, but if you said something about someone doesn't live in Vermont anymore, they stay out of Vermont for maybe 6 months and a day, and then something about allocating income. I thought if they were out of Vermont for 6 months and a day, they paid no income.
Well, if you have income earned in the state, then you have a tax liability to the state. And I'll look to Kirby to either, yeah,
But if it's a retired person.
For the record, Kirby nodded.
yes.
It's a retired individual. And then they don't have, let's say, their a teacher retirement system or something like that, without income earned in the state.
Well, my understanding is if they're not living in the state at all, then they shouldn't have tax liability to the state.
I thought, all right.
But if they're here
That's what
for-
I thought it was, then you
Yeah.
said if they earn income in the state.
Sure, so, but if they're living here for 5 months, let's say, and they're earning income in the state during those 5 months, then those 5 months, that amount of their income should be allocatable to their Vermont tax liability. Yeah.
Which, is it, am I remembering right that folks who come here for sort of extended vacations and work during their vacation, that also would be income that's allocated to the state?
Yeah, I mean, I know it's from just a couple examples from some friends who were sort of working from wherever during COVID when everyone was remote. Their HR departments were requiring them to report any time spent working outside of the state where they issue the W-2 to. What's kind of ends up happening a lot of times with situations like that is, if your income falls below, it's basically less than Vermont's standard deduction and personal exemption, the state doesn't require you to file because you're not going to have any liability after you take the deduction.
But if you're an actor on set in Vermont, you earn $5 million, you're gonna pay income tax on the $5 million you earn while in Vermont.
Presumably.
Right.
I know there gets to be a little bit of nuance with some of that. So kind of simple answer is yes.
And we can, if we wind up needing to dive deeper into income
Yeah.
tax this session, which we might not, we can spend some time on how that all works. Representative Feltus, did you have your hand?
I just wanted to clarify, we have a pending bill to exempt military pensions from income tax. So I presume that would go on this listing of exemptions and deductions. It would take it off of the income to start with.
Yeah, so there is actually an existing $10,000 exemption for military retirement pay. It's also included with the civil service retirement pension program. So there's something that exists, you can deduct or exempt up to $10,000 of that income. But there's a caveat that you have to choose between that exemption and the Social Security exemption when you do it. So you have to figure out which one makes more sense to your, if you have, basically the decision is, do I have more military retirement income or do I have more Social Security income when making that choice? Okay. So this is kind of a review of something Kirby walked over. There were some very large changes to federal income taxes as part of the Federal Tax Cuts and Jobs Act. I'm not going to run through all of the different changes. A lot of these are on here sort of for reference. But two things that I do want to call out here are these first 2 points. So in that bill, the feds were eliminating personal exemptions, and they were doubling the standard deduction, which is sort of, at the time, Vermont was coupled to these amounts. We just, every year as part of that link up, we just mirror what the feds are doing. That becomes sort of law of the land in Vermont. So because by eliminating personal exemptions, you're going to be basically driving tax liability up, but by doubling the standard deduction, you'll be driving tax liability down. That kind of creates some confusion or uncertainty in the year that it happened with, okay, what's going to go on with our tax revenue? Is this going to be a net positive, net negative for us? So instead of just letting that flow through, at the time, the legislature decided to basically, what were the personal exemptions and standard deduction before the feds eliminated it? Okay, that's our new, we have our own standard deduction and personal exemptions, and they grow with inflation, just like the Fed amounts were doing over time. So that was sort of a moment of decoupling to sort of make sure that that wasn't flowing through. A lot of the other changes, which again, these are here for mostly reference, they don't flow through to the state, so they didn't really affect us. But one thing I want to call out, and one thing that you all should definitely pay attention to this year, is that the personal income provisions of that law, the federal law, are expiring at the end of this year. And the reason for that has to do with the Byrd Rule, which I know Kirby went through, basically is implemented as part of a reconciliation bill so that they could get it through without the 60 votes in the Senate. The stipulation there is it can't increase the budget deficit at the federal level beyond a 10-year horizon. So I think at the moment, you know, if this were just all to expire because Vermont has already decoupled from some of the provisions that the law instituted, it shouldn't have much of an effect on the state revenues. But again, you should all pay attention because we don't know what they're going to do. They could make the other changes that could flow through. You know, like I said at the beginning, we sort of peg ourselves to what is the federal definition of AGI. I've heard a proposal floating out there to not tax tips as an example. That's something that you all would need to think about if it were to actually be implemented. So yeah, I think I've said everything about that. If there are no questions, we can get into some of the recent Vermont legislative changes. I mentioned that Vermont introduced its own standard deduction and its own personal exemptions. These grow by the same metric the IRS uses to grow federal brackets and other benefits and thresholds and things like that. It's used in a lot of other places in Vermont law. We adjust our brackets every year by the same growth metric as we're growing the exemptions and deductions now. So this is from 2018. In that year, sort of this, I don't think this part was a direct response to TCJA, but there was a collapsing of the top brackets, a slight lowering of the top marginal rate, so that we have the brackets that we have now. So I think we have 4 right now. There used to be 5. At the time, also took the opportunity to increase the Vermont EITC from 32% of the federal amount to 36%. So that's an instance, just as an example, where if the feds make a change to the EITC, that effect flows straight through into Vermont. We actually saw that during COVID when the federal government greatly expanded the EITC for, I believe it was single workers. So the effects of that flowed right through to the state and actually also boosted those individuals' state credit amount. And so,
know the answer to this, but since I'm coming off of appropriations where I still can't get over the fact that the reach up benefit is pegged to 2001 housing costs, I wonder, do we as a state sort of, as we make these incremental changes, we're affecting progressivity or regressivity in ways we're not aware of necessarily in the incremental case, but do we ever, every 5 years, just stop and say, did we take away with the hand, give with this hand and take away with this hand, or where are we with respect? Do you understand what I'm saying?
Yes, certainly not to the degree we probably should, given our limited sort of resources as a legislature, et cetera, et cetera.
Yeah.
I think we have the really great opportunity that we do have statutory schedules for I don't know if there's JFO has schedules, some of them statutory, some of them not, to do all of this really great reports for us. And the Ways and Means Committee at least generally spends significant time on those reports to see if we want to make adjustments.
So one thing that is coming up, that is kind of a big deal is our office once in 10 years writes the 10-year tax study. And we're actually coming up on 10 years from the last one that was due. Something that report does is look universally at Vermont's tax code and look at, over time, where money is sort of being funneled via the tax code to certain individuals and taxpayers, and also sort of how effective some of those programs have been at reaching those folks. So like if we talk about the EITC is the example here, that as part of the report, we actually look at how that fits in with the overall progressivity of the tax code. And
That's half the Oreo. I guess the question I'm asking is what the other half? Like when we choose to spend what we bring in.
oh, I see.
When you pair policies on the tax side with policies on the spend side, what's the net effect?
Gotcha. So I guess that report is mostly on the revenue side of
Yeah.
things, but yeah, I mean, we do, as the chair mentioned, go into a lot of reports that some of them deal with that particular question.
Thank you.
So there was a question about the charitable contribution that it was during this bill when the current iteration of that credit took form. Basically, it's just a 5% tax credit, so 5% of your tax liability up to $20,000. So if you basically can't take more than a $20,000 credit off that.
20,000, and but I was thinking, what is it if before, what do the rest of people in America, what are they able to take with the federal charitable contribution deduction?
Yep, and know that off the top of your head.
I was reading your slide. Can you repeat the question? Irving Key Legislative Council.
Yes. What is the federal tax credit on the value of charitable contribution?
It's a percentage of the contribution, and give me one second. It's either, I think it's currently 60% and it's moving to 50% with the expiration of Texas and Jobs Act, I want to say, but I'll verify that. Is that your question?
Yeah, the reason I'm asking is I'm wondering if you're middle income Vermonter and you make a contribution, does this 5% credit change? Does this impact, might it sway you away from making a contribution because it's not 50 to 60, then down 50% of the, can you give me an example so that I can understand this?
So in Vermont, the 5% credit, if you donate $1,000 to your favorite charitable organization, you get 5%, so $50 credit on your income taxes.
Instead of a 60% of that or 50% of that. So doesn't that, I'm thinking that would hurt. I remember United Way coming, they were really upset about this change back then, and other nonprofits were too. And I just wonder if we really should be limiting what people can deduct. But I mean, it's a policy question, I realize that.
So I mean, it's a relatively small number under Vermont law because it's up to $20,000. And then $20,000 is the charitable contribution, right, Pat? So 5% of $20,000 is the maximum credit.
But I'm thinking about donors who are not giving $20,000, they're giving $500 over the course of a year. And they would, if it goes with the federal, they would get 50 or 60% of that in a tax credit rather than just 5% of that.
I mean,
Am I-
from a behavioral standpoint, yeah, if you can deduct more of a donation, would certainly, sort of behavioral studies would suggest that an incentive to do something will make you more likely to do it, right? One thing I would say is, once you really start upping that percentage, it could get expensive quickly for the state. Potentially, it really depends on behavioral responses.
So we could follow up maybe and look at what the actual impact was when this was put in place. Would that be helpful to take a look at that? Because there was great concern over that being an impact, as Representative Bodie mentioned.
Getting that. Not getting it for $20,000.
So one distinction I'd like to point out before we move on is at the federal level, it's a deduction. So you're not getting taxed on part of that. So I just wanted to contrast that with Vermont, is that it's a credit. So that's kind of off the top, right?
It's off the top.
So there's a difference in how they're approached as well. So I don't want that to get lost.
And that's a good point. I mean, generally speaking, credits tend to be more expensive than exemptions are. Obviously depending on how broad they are, but because it's a 1-for-1 reduction of tax liability, and it's not that sort of indirect reduction right before you flow through the tax brackets, it can typically be. I mean, you saw in this slide here, the two most expensive tax expenditures to the state are both credits, and part of that is, part is due to the extent that they're providing support. The other part of that is because it's dollar for dollar reductions in tax liability. Yeah. So if we're okay, there were some additional changes in 2022 as part of Act 138. This was the act where we actually had the establishment of the child tax credit. That's $1,000 per child, per qualifying child ages 5 and under. If you are under 125,000 in AGI, you can get that full 100% amount. It phases out over the next $50,000. So if you're over 175 in AGI, then you've essentially brought your eligibility to zero. A plug there. We also have an issue brief on that particular tax credit as like a 1-year look back. As is part of the same bill, it expanded the Vermont Independent Care Credit to make it refundable. It was previously non-refundable and equal to 72% of the federal credit. The EITC was further expanded to go from 36 to 38%. And it established one thing that missed on the last one. This bill from 2018 was the first introduction of the Social Security income exemption. So at the time it was first implemented. So if you're a single person with AGI up to 45,000, fully exempt all that income. If you're married up to 60,000, again, fully exempt all that income. So when we come to 2022, there was a further bump out of those thresholds. Both went up $5,000. So if you're single and you earn 50,000 or less, again, full exemption of that income. And then to your point earlier, this is also when there was the implementation of that $10,000 military retirement benefits exemption. And again, you have to make the decision between the two. So that's recent Vermont legislation. What I have next is just to sort of big picture show you sort of what the importance of personal income taxes are to Vermont revenue. So this is a chart going back to 2005, and it's just showing what share of general fund revenue is attributable to personal income taxes. So in 2005, it was 48%, a little less than half. But now we're pushing up over half of general fund revenue, available revenue, is primarily sourced from the personal income tax. So it's sort of the biggest funder of general fund activity. And yeah, I mean, it's been increasingly growing over time. You do see a quick ramp up during COVID. I'm sure anyone who's listened to the state economists with their forecast before will tell you of a big influx of federal dollars directly into Americans' pockets. So, you know, that did a couple of things, helped push up household savings amounts. So they had more sort of ongoing discretionary spending. And it also increased their immediate discretionary spending. All of that income was taxable at the time. So you did see increases sort of nationwide in personal income tax revenue from some of that activity. But also over that time, we've been seeing a lot of wage increases, particularly on the lower income end of the spectrum. So, you know, it's becoming an increasingly important general fund revenue source.
Have you seen a change? I mean, I think, was it you who wrote a fiscal note on business pass-throughs and C corporations?
Graham Campbell wrote one of those a few years
So I
ago.
should have looked that up again, but are you seeing a change in who's paying income taxes?
Oh, I don't have that with me here today, but I know we have some numbers showing sort of what portion of personal income tax revenue is coming from pass-through business entities. Because I guess to your point, and we'll talk about this a little bit when we talk about corporate income, but if you have a pass-through entity, the partners or sole proprietors, they're paying that based on the personal income schedule. And so we do actually have some numbers about what part of overall personal income tax revenue is from those particular entities. I just don't have those numbers with me today. And I could send you that.
Yeah, that'd be great.
Oh, Representative Brennan.
The previous question there, that has to do with ways that businesses are you talking about businesses transferring their income to their or owners, and then the owners declaring that on their personal tax returns? Is that what you mean?
No, so if you're like a sole proprietor and maybe you own like a flower shop or something, you're not necessarily incorporated as a C corp. You're probably set up as some kind of LLC or just an S corp or something like that. But basically, there's a separate form for self-employment income essentially that you do have to declare, do build into the sort of building up to your AGI, the definition of AGI. So that's purely, that particular kind of income is purely on the personal income tax side. I think maybe what you might be referencing in addition is people will receive like dividends from shares they might own in a publicly traded company.
Yes.
So that dividend income also shows up here, but it's sort of a separate tax calculation from what the corporation itself is paying. And I'm trying to distinguish here between a C corp, a corporation, and those partnerships, LLCs, and sole proprietorships, which are treated differently. But the dividend income, if you own a share in a C corp, that is rolled into your income definition.
Thank you. I see now. And I would like to, if there is any kind of a summary about those two lines. Turns out like that too. I know you guys are crazy busy. Don't rush whenever you have chance.
I'll look for the fiscal note and send it to you so you don't have to worry about that.
I can also send it to Sorsha, so everyone has it.
That would be great. You're doing a lot. We appreciate it.
So this is sort of a little different view. It's just looking at who pays by income band. So you can see here that at the very lowest, people with negative AGI or below 25,000, they're actually getting more money back than they are sending to the state. And then on the very opposite end of the spectrum, people over 300,000, they're contributing about 42% of overall state personal income tax revenue. So again, I think this highlights one of those charts we may have seen earlier. We're at the lowest end of this income spectrum. We're really not taxing people at a high rate compared to our neighbors. But at the higher end of the income tax spectrum, we are getting a large portion of our revenue from those taxpayers.
So the percent of total that you have there, it's the first one is the percentage of returns into sort of filings, and the other one is the percentage of total amount paid. Okay. Thank you.
Yeah, so, and I guess one thing I'll highlight here is you see because we have a marginal income tax bracket structure, even the people at the highest end of the spectrum, the base income they are earning, it's flowing through every single bracket. So when you talk about making changes to rates, not that you are, just if you were to, any adjustments to the lowest end is going to raise the most. It's typically, because it's the broadest base, raise the most amount, whereas larger increases at the highest amount would have to be made to sort of equal out. And basically, I think this again comes back to one of the 6 principles of a high quality tax system. It's that the broader the base, the more stable the income from that is going to be. And also, it's just the broad base is more stable, essentially. I can leave it at that. And another point, which is also interesting, those people above 300,000 and even those people above $1 million, typically those people aren't actually repeat filers at that income level. You know, a lot of times people will get into those really high income levels due to things like sale of a business or other sort of capital gains windfalls that give them a sort of maybe 1 or 2 year quick influx into their income. So we do see a lot of people kind of coming in and out of those top levels. There are obviously some people that maintain that top level, but there's often a lot of churn there.
I remember in past years, it might have been you, it might have been Graham, I'm sorry. Said that there were folks who just sort of like floated around that line sometimes too, and like stayed sort of close to the line, sometimes above, sometimes below.
Yeah, absolutely.
Yeah, Representative Mooney.
Thank you. I definitely learned from Representative Ansel about the start at the bottom and go up, and then you can fix at the bottom with credits and exemptions. And that way you have the stable tax base. Well, she didn't say that, I just said, I think she probably felt those things. But then you can repair whatever damage you're doing at the very bottom. And then you have the stable tax base all the way up. It's just a point to make.
Thank you.
So this is kind of a different visualization of the same thing. In those blue bars, that's the number of state returns. You can see the biggest bars are at the lowest income spectrum. And then the orange line, again, that's the amount of tax paid by those same income bands, inverse relationship. So again, just kind of a different visualization of that table from before. And this is the effective tax rate chart that I wanted to share. So again, you see that essentially looks like below 25,000 on average, all of those people are going to have negative tax liability. And when I say negative, I mean they're actually getting money back through some of those credits, like the child tax credit, EITC, those kinds of things. And then really it's not until you get above about 150,000, it looks like, where the average effective tax rate is above average for the state as a whole. And again, that kind of comes back to just the number of people that are in all of these income buckets, the amount that they're paying.
You said again, the average effective tax rate is above average. Was that your sentence?
All right, so the black line, it's sort of right here. That is the statewide effective tax rate. And it's each little node. So once we get to here, which is, it looks to be about 150,000, the average effective tax rate within that income cohort. So it's, yes, it's the average of the average. That's when you start to get above the statewide average.
Thank you.
Thank you for asking me to clarify that.
Thank you for that clarification. Can I ask you to go back one slide? I'm sorry, I'm slow. Have you ever run this slide against the benefits cliffs in healthcare and social services? And does that have anything to do with the shape of the bars?
I think Joyce did that.
Yeah, we haven't updated the benefits cliff chart. That was a big project that we actually brought Deb Brighton in to do that work for us.
Yes.
It was amazing.
So it's, I think maybe from like 2015 or 2017. It's a little outdated at this point. But I haven't personally run this chart against those. They've probably changed a bit, but that, I will just say again, that was a very big undertaking that
It was before
Actually,
the child
contracted.
tax credit.
yeah.
And the cliffs on the exchange are quite significant. And I'm just curious if there's more action.
We could, when Deb was sharing that work and then Joyce shared, I think Deb's work following that up, a lot of the policy decisions we made after that were based on cliffs and troughs that were identified in those graphs. And so redoing it would likely look significantly different than that first time. Because we actually did make policy decisions based on those charts soon after that.
And I'm just wondering, because I know the feds have made changes, other people have made changes.
Yes.
It's like everything is dynamic.
Seeing it again would be very helpful. Like next week or something.
No, that's.
It was a joke. It was a joke, like.
Maybe next year.
I was thinking like, you know, on the possibility list for a summer project.
Yeah.
Yes.
There's, sure.
So this is the last slide I have on personal income taxes.
Perfect timing.
So now we get to the really exciting part, and that's corporate income tax. And so we've talked about some of these things a little bit, but
And before you jump in, this was a huge undertaking a few years ago and we did really good work. And I don't feel like the public, including the business community, knows that we did this. And so I just like, we want to take pride in our tax structure. This is a strangely great place to pay attention to. It was like a deeply bipartisan, much appreciated piece of legislation that we worked really hard on. And is maybe very weedy and Byzantine, but I think worth the effort to understand.
yeah, so I'm gonna try and do like a mix between like a 101 and 201 here on corporate income. Some of it will repeat. Hopefully repetition is always good for me to learn. So you might hear some things that Kirby said. So Vermont, like the federal government, treats taxes on net income / profit depending on how the business is structured. Corporate income tax applies to C corps, which I actually learned, and that was a fun trivia thing, that C corp refers to section C. That was new to me. But yeah, so the C corp, that part of the IRS code, those are the only businesses that are subject to the corporate income tax. We talked about those pass-through pass-through entities. They're structured differently. I know there are some situations where an S corp may end up being taxed like a corporation, but broadly speaking, you've got pass-through entities, personal income tax. C corps, corporate income tax. So I think that's an important distinction that sometimes gets a little lost because they are sort of two different animals. So yeah, currently Vermont, we apply a 8.5 marginal tax rate on net income above 25,000. There are 2 income bands below that, which we'll see in the next table, but generally speaking, our highest rate kicks in at a relatively low level of net income. Corporate income of the unitary group includes the total net income of the parent corporation, all subsidies. I'll get into a little bit later how some recent changes sort of kind of put a fine point on that. So it's really the parent company and all of its subsidiaries. That's sort of a unitary group that are sort of filing together and doing their calculations, which I've got some charts that'll show you how that works, together. Sort of brings everyone into the fold together so that you don't have this disparate, all these little entities that ultimately have one giant megacorp parent, and help simplify how this is done. So before 2023, there was a 3-factor formula that was used to basically figure out how much of your parent corporation's total profits are actually attributable to the state. It included a portion for payroll, property, and sales. So I'll talk a little bit later of recent bill that changed that, and why that matters. But now we have a single sales factor, and the only thing that matters is how much do you sell into the state. And then we use the same definition of net income as the feds do. So it's an area where we're coupled, and there are some ramifications from that from TCJA. And to further caveat, some of those might be changing with the Pillar 2 discussion, which I know we're kind of tabling until later. But in a sense, we're coupled. So we use a lot of the same definitions of federal net income, just like we do with personal income. So firms with zero taxable income, which are surprisingly roughly 70% of total corporate income returns. I've actually talked to Commissioner Bolio about why this is like this. And he actually said there's a lot of corporations that, just to make sure they're being compliant, file returns that they don't need to. They have zero allocable income to the state. So that is one reason why there are so many returns that have zero taxable income. Some of those do, basically they're reporting no profits. And so that's an instance where they get kicked into our alternative minimum tax schedule. But I thought that was a kind of interesting nugget.
Representative Brand?
Isn't this situation you just described, isn't that an example of the companies who actually do have profit, but before the end of their fiscal year, they transfer that profit in a bonus or some kind of a check to their owners, and the owners count it on their personal tax, not the company's tax?
So I guess my question is, are you referring to sort of shareholder dividend payments, or?
Possibly, you mentioned that before, and I wonder is that the benefit these companies are looking for? And then the other one that you mentioned was the S corps.
Mhm.
And is that the benefit again, those companies are looking for, to get all the profit out of their own books and onto somebody else's where there might be a lower tax involved or write-offs?
So moments like this, I wish I had my CPA certification to give a more qualified answer, but
Do that.
I'm sure that there are, and maybe Kirby can talk about this a little better, but there's definitely ways for the tax department to look at returns and see if there are red flags that are popping like that, of people trying to sort of quote game the system.
Yeah.
I haven't heard of the specific example you're talking about, but you know, if you're a C Corp, which is sort of the example here, you know, money being paid out in dividends, you know, that'll be being taxed on those people's personal income tax filings, right?
Is this enough? And I don't know if maybe you're talking about sort of unitary versus combined filing, and if just sort of going through what that sort of the changes we made a few years ago, and so that's actually harder to do.
Yeah, I mean, so I want to come right back to this after we do that, but I'm going to jump ahead a few slides. Several slides.
How many slides?
Any slides?
Maybe we should wait to get to that instead.
Yeah, that's okay.
Well, it can be quick.
Okay.
So there was a repeal of the 80-20 rule. Actually, there's two things I want to say. There's a repeal of the 80-20 rule, which Kirby mentioned earlier or last week. So previously, C Corp had a subsidy whose primary source of sales were from overseas. which is where you get the 80 of the 80/20, right? That was excluded from the sales, calculate the sales, and I'll define this better when we jump back. That was excluded from the sales of the parent C Corp. So I think that's maybe something you're talking about where an external entity wasn't being included in the unitary group previously because most of its sales were happening overseas or out of the country. This is basically saying, no, you have to include that in the unitary group and report all of those subsidies under the same umbrella of the parent company, which matters when you get into looking at what the unitary group's net profit is, what their total sales are, and what their total sales into Vermont were for figuring out what can be allocated to the state. So that was a change that was done to make sure that the whole sort of ecosystem of the parent company was being brought under one when filling out the tax form. The other change that was also made to sort of tie the whole unitary group together was the move from Joyce to Finnegan. So Vermont previously had used the Joyce methodology, and that limited a C Corp's nexus to Vermont, a C Corp's nexus to Vermont only to its subsidiaries that had nexus to Vermont. So if you have a subsidiary that doesn't have any sales here, doesn't have any property here, doesn't have payroll or things like that, they could be excluded from that unitary group. By moving to the Finnegan methodology, even if just one of those subsidiaries has any sort of nexus to Vermont, the entire unitary group has to file as a whole with the state. So again, that's just another example of bringing the whole, sort of, I use the term ecosystem of a corporation under one umbrella to use all of their sort of financial dealings to determine what their tax liability to the state should be. So now I want to jump way back.
Do we need to know the origin of that to understand the impact of that, those two changes?
I don't think so. I think it's. Yeah, no, I think the move to combined filing is sort of is what it is and is towards the intent that to some degree Carolyn was describing.
And at the time, it really was a modernization of the tax code in Vermont. It's something that a lot of other states have been moving to do exactly that. There's some that still kind of adhere to some of the old ways, but we've seen a lot of states moving to a structure much more closely tied to what we have now.
My question is because I think I know what it's doing, but if there's something surprising.
No, I think it's really doing what you think it's doing.
Okay, that's all I'm checking. Sorry.
So yeah, we use the same definition of taxable income for unitary groups within the US as the feds. We use a single sales factor, and I want to draw your attention to two things. So this right here is the first part of the equation, and that has to do with the federal definition of taxable income. That's where we're coupled. And then the second part, this has to do with how we allocate a corporations and what we can say is attributable to their activity in Vermont and sort of what we need to be taxing, because that's their dealings with the state. So the first piece that we take from the entire unitary group is what are your total sales of your unitary group, right? All of your subsidiaries, what are the total sales? What's your total revenue that you're doing? And then we also have to ask them how many of those sales occurred in Vermont. And the reason why this is important is that you get this ratio here. So, I mean, let's say you've got a corporation with $100 in total sales. $10 of that was in the state. 10% of your total corporate income has to be reported onto your Vermont tax file. So we take those $10 and we put it through our bracket. So this is the $100, this is the 10%, and then this is going to be whatever the tax rate is equals your Vermont tax liability. So I want to quickly talk about the single sales factor. The reason why this shift was pretty significant is under the old regime or process, not sure what the best word for that would be. There was sort of three factors that went into figuring out what portion of your total corporate income should be sent or should be attributable to the state. That was your property, that was your payroll in the state, and it was, again, your sales. So if you think about it, if you're a corporation that is based in Vermont, but all of your sales are basically outside of the state, under that old system, you'd be getting dinged on your property in the state and your payroll in the state. And that would be contributing to your apportioning your corporate income to Vermont. By removing those two pieces, if you're in the state, you're basically, those would have been one of those corporations that kind of came out ahead under the system. Now, previously, if you were a corporation based in Massachusetts, all of your physical footprint was in Massachusetts, but you were doing basically selling all of your product into Vermont, you'd be getting a break because you have very low factors for property and payroll in Vermont. So that's an example of a corporation that maybe would have come out a little behind by that shift. So essentially what the shift does, though, is it makes Vermont say, we don't care where you're based. If you're based here, it's not going to hurt you. If you're based elsewhere, again, it's not going to help you or hurt you. But if you are selling into our market, that's how we're going to define basically what we think your sort of share or contribution to our corporate income taxes should be. So it really is agnostic about where you're based now. And I think that's an important point. So yeah, I mean, if you think about, I mean, I've heard sometimes sort of the misconception that, oh, if Vermont is going to raise taxes, or if they're going to cut taxes in this space, it's going to help or benefit Vermont-based businesses disproportionately. Like if we compare our corporate tax rate to a neighbor, it seems like people sometimes say that's a competitive advantage. Our firms are going to want to move to that particular state. If you move to that state and you're still selling into here, it's not going to change your liability. Does that make sense? So that's kind of the very basic how we get to, what does a corporation owe here? Because the next step is really just running that through the tax rate schedule. And again, it's marginal, the lowest rate being 6, only up to 10,000, and the highest rate being 8.5 for anything above 25,000. And I mean, once you get to this point, it gets pretty simple, I think.
So just curious as to how these brackets of amount of income were determined. Like why was it 10 to 25? Why did we stop at 25? Maybe that's
I think that was a policy decision.
On the minimum taxes or on the,
both really.
I remember the minimum tax conversation. We really wanted the lowest. In lowering the lowest brackets on the minimum tax, there are a lot of very, very small C corps that it's sort of unclear why they're organized as C corps. And it was like a strange decision that someone made with an attorney one day, maybe not even understand the implications of that decision. I don't know. So wanted to really like hold those folks as harmless as possible. Like some general stores that are cooperatives are C corps technically, that kind of thing. And then the top bracket, was a conversation with tax about sort of where to set that bracket appropriately to make sure that enough taxpayers were in it, but not too many taxpayers. Sort of reverse engineered from how much taxes people were paying.
I remember
Representative,
there was only a handful, 300 million and over.
Mhm. Yeah, it was more than a handful, or we wouldn't have been able to get the information. It was a few handfuls. Representative Feltus and then Maslin.
I just wanted to clarify, that the corporate income tax is based only upon their sales within Vermont.
Earnings.
So,
So,
so, so yes, but so if we come back to this, so we start with the federal definition of sort of overall. How much of the overall profits or net income, to your point,
Mhm.
is then attributable to Vermont is based on sales or revenue. So there's a distinction here between the taxable income rate, net income or profit, and the sales or revenue. So the net income is sort of the base and the sales are really just meant to determine how much of that can be apportioned. That makes sense.
okay. It just struck me that we often hear people complaining about Vermont taxes are so high and we're driving our businesses away. But this reference is only to income taxes that this is what we're talking about is the income taxes. Now, some people may be saying that it's property taxes or other kinds of taxes in Vermont that might drive businesses away, but it's not our corporate income taxes. In that regard.
I think that's a fair statement. I guess maybe I should put a fine point on my comment earlier is the corporate income tax code itself is sort of agnostic to where you're based. Obviously, if you have a warehouse here or, something like that, there are property.
There are
tax
other things
inputs,
that
yeah.
relate to that,
Sure.
yes.
Mr. Maslin, did you still have something?
Yeah, comment, as we're working through Joyce Finnegan and this sort of stuff like that, one of our intentions was to try to encourage businesses to actually locate their sales in Vermont. We were looking at Vermont sales rather than fractions of income from here, there, and everywhere. And that seemed to make sense, and I'm not sure if the jury is in or out on whether we were effective. And I'm not a CPA. Don't ever hope to be. But if I were a business looking at this sort of stuff, I would say, tell me something that's simple and straightforward that I can follow. And it seems to me we're going in that direction intentionally or not. Straightforward. A business is located in Vermont without having a raft of CPAs doing the work for us. I think we're going in the right direction. This does not necessarily align with our intention a couple of years ago, as I said, trying to get businesses their sales, in Vermont. And I'm not expecting an answer. I'm just kind of going around in circles trying to figure out what my impressions in general terms of whether they're going the right idea, right way or the wrong way. I think we're going in a good direction. And I'm not soliciting comments, but people can tell me I'm wrong.
Thank
So we just looked at this and I just want to, whether you are subject to the marginal tax rate structure or the minimum tax, the basic metric that we're used to figuring it out, it's the income versus gross receipts. Another way to look at profits versus sales, net income versus revenue, kind of all sort of interchangeable terms, but I just want to make sure that people understand when we get to the minimum tax brackets here, that's based on a corporation's sales into Vermont. It's not determined by their net income. So it's just whatever calculation comes out on top, that's what you owe.
Representative Wozniak?
So can you just say that one more time?
Sure. Maybe I can give an example. So let's say you go through the federal definition of income taxes. Let's say that you're really unprofitable. You maybe even are showing slight loss or something. So you go through, but you have a bunch of sales into Vermont, right? Let's say you sell $4 million worth of product into the state of Vermont. So we go through this equation here. We find out that your liability is essentially zero. But you have $4 million worth of sales into Vermont. Well, you're basically, it's kind of like have a fee in a way for having access to the Vermont market. So instead of having the zero liability, we say, hey, you're still doing a lot of business in here, $4 million worth of sales into Vermont. you owe us $2,000.
So is it fair to say that a simpler way to say that would be whichever is more?
Yeah, and so the point I just wanted to highlight here is that the measurement for the brackets, whether it's net income or whether it's sales, I just want to make that distinction between what the two brackets are looking at. Okay, so that's kind of how the math works. I want to look at again, sort of similar to what we looked at with personal income. And unfortunately, as of like 3 hours ago, this slide is outdated. So this is based on the July 2024 consensus forecast. Tom and Jeff said that they were expecting us to get about 226 million in revenue in this fiscal year. And if you look at that in the grand scheme of the general fund, that's about 10% of total revenue. So we were looking at personal income earlier, that's over 50%. This is about 10%. So between the two, we're up over about 60% of total general fund revenue from these two sources. And just for context, tax revenue from corporations was approximately just under 240 million in fiscal year 24. So the July forecast from this year represented about a $12.5 million decrease year over year from last year, or 5%, already outdated, right? So in the first 6 months, and this is some of the information that led into the current forecast, we were tracking about 24.7 million or 25.1% ahead of forecast so far. And sorry if I'm repeating something Tom said earlier, but this was pretty much all due to a one-time event that happened in September. And I think I just want to point that out to show how lumpy and sort of volatile this tax type is. It's very dependent on business cycles and what have you. If you were to just take that one singular one-time event out, through the first 6 months of the fiscal year, sorry, that 1 month, I don't know how much is directly attributable to that one event. If you took that month out, corporate income revenues would be about 1.2 million below forecast. So that's a pretty substantial difference, 25 million versus 1 million below, right? All from largely attributed to one single event.
By a single event, do you mean like the eclipse or the apocalypse, or do you mean like a single corporation having something happen?
So I think this particular event was not one single corporation, but a very, very small handful of interconnected corporations working in a similar space. That is as detailed an explanation as I was allowed to be given. So it's related to specific corporate activity amongst a very small number of corporations. It's not, like you said, a bunch of everyone's coming to say hi to the eclipse. And we do a lot of great business and our companies make a lot of money. No, it's corporate activity, mergers, acquisitions often. Maybe occasionally there's been instances where a corporation realizes they should have been filing with us for the last 5 years and they haven't been, so they're catching up. Just like some examples, but yeah. And again, looking at the forecast going forward, Tom and Jeff are it's looking like they're expecting it to remain about 10-11% of total general fund revenue going forward. Just to show you what that's looked like over time, back in 2005, it was a much smaller piece of the pie. It was a little under 6%. Gradually kind of increasing over time. And there is a bit of an inflection point, and it doesn't necessarily start at COVID. I think that the percentage of corporate income in the general fund increased at the time that sales and use was moved out of the general fund. So it's sort of a redefining of the overall pie, if that makes sense. So there is a bit of a lull right before that shift happened and that started increasing. But I think, once you get to the COVID years, this really dramatic spike, that's because corporations were doing really, really well. And so I want to come back to, I'm going to go back a couple of slides in a sec, so I to jump around a little. But this is again looking at sort of just corporate profitability nationally. And again, you see that similar kind of big spike during COVID. Corporations were really realizing a lot of profits. Big increases in that area. Federal tax collections, even with the sort of changes that the Fed's made, going to a single rate, really reducing that top marginal rate. Even with those changes after TCJA, federal tax collections have really kind of taken off because of, again, coming back to corporate profitability, there's been a big ramp up basically since COVID started. All right, so now I want to jump back. So what this chart is showing here, and I want to highlight, is even though, yeah, we saw that big ramp up, it's still very volatile tax type. A lot of the corporate revenue, again, that's coming from a relatively small number of filers. I think I showed you the number earlier, roughly 70% of corporations are either paying a minimum tax or, they're have essentially no tax liability. And so, it can be very dependent year to year, Fed rate hike to Fed rate cut. Anything within the economy that's affecting corporate profitability does essentially eventually tie back into how Vermont does. And so what this is showing you year over year, what's the percent increase compared to last year? So from 26 till 27, the amount collected went down. Next year, there's a slight increase. Then you're going into the negative territory again, then you're back positive. So in terms of percent year over year changes, it does bounce around quite a bit and can be, fairly difficult to predict what it's going to do. And, I think the one-time event we were just talking about sort of highlights that, because while September had a big positive for the state one-time corporate event, it's also true that sometimes the state's giving out big refunds to corporations because they miscalculated their estimated liability. So Vermont's not alone in having corporate income tax. 44 other states have it. 15 of these states have a graduated bracket or marginal rate structure like Vermont does. The remainder just have a flat tax. I did mention that a lot of states are sort of going down the same modernization path as Vermont and moving to a single sales factor, but there are those that still use things like property and payroll in addition to sales to get to their apportionment of net income. So like I mentioned, at 8.5, Vermont's corporate rate starts at 25,000. I went and looked at other states, like around 25,000, what's their rate at that level? And these are the states identified that have a higher top marginal rate than we do at that particular level. And then there's a link there that actually points you to this table, which, again, top marginal rates don't tell the full story. There's differences in how it's apportioned, there's different rate structures. But for reference, this is a good tool if you want to sort of explore a little bit more how other states have their brackets structured. We looked at these. And then the last section has to do again with the Tax Cut and Jobs Act and then some related Vermont legislation. So yeah, Kirby covered a lot of this. TCJA implemented a flat tax of 21%, bringing the top marginal rate down from, I think it was 37%, and just now to a straight flat tax. Implemented a territorial system, which is kind of how Vermont operates also, where we're only looking at domestic, for the most part, domestic activity. Now there is a new sort of income type that was defined in this law called Subpart F income. Kirby started discussing this a little bit, and I think sort of our agreed best course of action right now is to sort of table it until we can dive more into Pillar 2 because it gets pretty complicated pretty quick.
I like the bold right there.
You too.
Well, I know Kirby's excited to dive into it. So the TCJA corporate changes don't expire. Actually, the Subpart F income is sort of scheduled to adjust for, at the end of this year. But, and so that's how they're sort of satisfying the bird rule reconciliation rules around this bill. But again, there could be some changes that the US needs to make in that definition to comply with the OECD Pillar 2 push. These are kind of for reference. Kirby ran through them. These don't affect Vermont corporate income tax. And then I have a couple of slides. We talked about two of these pieces, or three of them actually. There is and I think I might have started this section saying Vermont's response to TCJA. This is not what this was. This is actually sort of a separate endeavor to modernize the Vermont corporate income code. So we talked about the 80-20. I think we've talked about single sales factor for apportioning that income to the state. We talked about how Joyce and Finnegan are different, and how, again, this is an effort to bring all of the subsidiaries of a corporation under one umbrella. There's the throwback rule repeal. This is kind of a small piece. Basically, if a corporation selling into a jurisdiction or into a state which it had no nexus, therefore no taxability, it was required to count those as Vermont sales. Repealed that. And again, we talked about the minimum tax law structure, or the minimum alternative minimum tax structure. There is more information on these different things that happened. I've got a link to the fiscal note that was written about them, but I have the table from there in here just to sort of show. It appears that it was the intention to basically create a revenue neutral modernization of the system. I think all these pieces were sort of calibrated and included to, as you can see in that bottom line there, create sort of a net neutral impact on corporations and their dealings with Vermont. So I hope that was exciting for everyone. I'm happy to answer any questions.
Right. Tim Brannigan, did I just see your hand or no? No.
Well, it was exciting, but it's the kind of thing that you gotta look at once and then look at it again. And, I know there's a lot of reviews that I need to do, because this stuff comes in my brain, and then I'm not a CPA. My husband doesn't tax returns. So it's hard for me to hang on to it. And then every 6 months I come to this committee, and it's sort of a new one. I don't get it.
I'm happy to come in and talk about this anytime as a palate cleanse for your ed finance.
Wow.
I'll confess for Representative Brannigan, since I joined this committee, every tax season, I tell myself I'm going to do my taxes by hand myself as like a personal learning exercise. And every year I file an extension and send them to my account. Without even starting the project. Yeah. Representative Maslin.
Yeah, last year, or not last year, several years ago, down in our bigger room with lots of windows.
It was smaller, but it did have better light.
When Janet Anthony was chair, some of you may remember, we had sort of a quote of the week or something like that up on the whiteboard, that some things that people was before many more times. But I think palate cleanse with regards to what we're doing here is really a quote of the week. It's really a genius.
Quote of the year.
Thank you very much for joining us. Appreciate it. And